As of Tuesday, September 9, 2025 at 12:15 p.m. Eastern Time, Opendoor Technologies Inc., trading under the ticker symbol OPEN on the Nasdaq, is priced at $6.26, reflecting a significant intraday surge of over 4.13%. While many retail investors, perhaps drawn to platforms like Robinhood or SoFi Invest, are likely celebrating this upward momentum, what they may not be fully grasping is the undercurrent of institutional maneuvering and the stark dichotomy in analyst sentiment that paints a far more complex picture than a simple daily gain. The prevailing expectation is that Opendoor, as a pioneer in the iBuying space, is on a straightforward recovery path as the housing market stabilizes. The reality, however, is a high-stakes battle between a business model that is incredibly sensitive to macroeconomic shifts and a market that is rewarding its technological disruption narrative, creating a volatile environment where fortunes can change with alarming speed. The common belief among many engaged in online investing is that Opendoor's fate is intrinsically tied to the broader real estate market. If interest rates ease and home sales pick up, the company is expected to thrive. While this is not entirely incorrect, it's a dangerously oversimplified view. The deeper, more critical reality is that Opendoor's profitability hinges on razor-thin margins and the accuracy of its pricing algorithms in a market that has been anything but predictable. The recent positive stock movement isn't just about a potential housing recovery. It's also fueled by a narrative of improved unit economics and a strategic pivot towards a more diversified service offering, including mortgage and title services. Yet this optimism is challenged by recent downgrades from analysts at firms like Keefe, Brulette & Woods and Citigroup, who have shifted their ratings to underperform and sell respectively. This clash between the bullish narrative of innovation and the bearish warnings from seasoned financial analysts creates a significant tension that any serious investor, whether self-investing through an individual brokerage or using a service like Schwab Intelligent Portfolios, must carefully consider. Looking at the recent trading activity, the daily swings in Opendoor stock have been pronounced, with a high of $6.40 and a low of $5.90. The trading volume is robust, exceeding 152 million shares, indicating a high level of interest and conviction from both buyers and sellers. This heightened activity is not just retail-driven. Institutional investors are making significant moves. While firms like Vanguard Group hold substantial positions, recent filings show a decrease in their holdings. This suggests that some of the larger, more cautious players may be taking profits or reducing their risk exposure, even as the stock price climbs. This institutional selling pressure, even if subtle, is a critical piece of the puzzle that often goes unnoticed by those focused solely on the daily price chart. The intense volume and the divergence between institutional actions and retail sentiment are classic signs of a stock at a crossroads, where the expectation of a continued rally is colliding with the reality of significant underlying risks. Platforms like Interactive Brokers, with their advanced trading tools, would allow sophisticated investors to analyze these volume and ownership trends in real time, providing an edge in navigating such a volatile landscape. Opendoor Technologies operates as an iBuyer, a real estate technology company that directly purchases homes from sellers, makes necessary repairs and renovations, and then aims to resell them at a profit. The core of its business model is the use of proprietary algorithms to generate near-instant cash offers for homes, providing sellers with speed and certainty that the traditional market cannot match. This disruption of the age-old real estate transaction process is what initially excited investors and drove the company to a lofty valuation after its SPAC merger. However, the model's capital-intensive nature and its vulnerability to housing market downturns were brutally exposed in recent years. When the market cooled and interest rates rose, Opendoor found itself holding a large inventory of homes that were declining in value, leading to substantial losses. This period of financial distress forced the company to reevaluate its strategy, leading to layoffs and a renewed focus on risk management and profitability. The company has since expanded its offerings to include partnerships with home builders and a more agent-centric model, attempting to create a more resilient and diversified revenue stream. While past performance saw the stock plummet from its all-time highs, the recent surge indicates that the market is willing to give its revised strategy a chance, creating the current dynamic of high-risk, high-reward potential. Investors using platforms like Fidelity, with their extensive research tools and access to Fidelity ETFs and Fidelity mutual funds, can delve deeper into the company's financial history and strategic shifts to form a more informed opinion. The Fidelity mobile app and trading platform provide on-the-go access to this critical information, which is essential in a fast-moving stock like Opendoor. Looking toward the future, the outlook for Opendoor is a study in contrasts. The bullish scenario hinges on a soft landing for the economy, where mortgage rates stabilize at a manageable level and transaction volumes in the housing market recover. In this environment, Opendoor's scale and technological advantage could capture significant market share and achieve sustainable profitability. The expansion into adjacent services could also create a powerful ecosystem that increases the lifetime value of each customer. However, the risks are equally substantial. A renewed downturn in the housing market, triggered by persistently high inflation or a broader economic recession, could be devastating for Opendoor's iBuying model. The company's ability to accurately price homes in a rapidly changing market remains a critical uncertainty. Furthermore, competition is intensifying, not only from other iBuyers, but also from traditional real estate companies that are adopting technology to streamline their own processes. Comment below with your thoughts on the housing market's direction for the remainder of the year. The tension between the expectation of a tech-driven real estate revolution and the reality of a cyclical, interest rate-sensitive industry will continue to be the central theme for Opendoor stock. Whether the company can successfully navigate these challenges will determine if the recent rally is the beginning of a sustained recovery or simply a temporary reprieve in a longer-term struggle. The coming quarters will be crucial in demonstrating whether the company's strategic adjustments are enough to build a truly resilient business. In summary, the narrative surrounding Opendoor Technologies is far from straightforward. The expectation of a simple recovery tied to the housing market is being challenged by the complex reality of a business model with inherent vulnerabilities and a divided analyst community. While the recent price action is encouraging for those with a bullish outlook, the underlying institutional activity and the significant risks associated with the iBuying model cannot be ignored. The contrast between the company's innovative potential and the harsh realities of the real estate market creates a compelling, albeit volatile, investment thesis. The path forward is uncertain, and investors must look beyond the daily headlines to understand the deeper forces at play, recognizing that in this high-stakes game of market disruption, the line between triumph and failure is exceedingly fine.